Dividend investing is the fastest way to poor investment returns, and Buffett will agree. The data shows it straight and clear. Let's dive in. Warren Buffett has been called many things, but there's one thing he isn't called often: a fan of dividends. In fact, when you look carefully, Buffett essentially doesn't like dividends in the sense that he doesn't favor companies paying them out when better uses of capital exist. Here's the truth behind that statement. His company Berkshire Hathaway paid a dividend only once, in January 1967, 10 cents per share. Buffett later summed it up this way: "I can't remember why I suggested this action to Berkshire's board. Now it seems like a bad dream." Why does Buffett view dividends this way? Because for him, the question isn't whether a company pays dividends, it's what the company does with its profits and whether those actions will drive long-term returns. He has observed that paying out a dividend is often a sign the business has no better use for the money. For him, the key drivers of future returns are things like return on invested capital, ROIC, growth in revenue and earnings, low debt, and a strong competitive advantage or moat. Many investors believe a business that pays a dividend is safe, secure, low risk. It looks conservative, they say. Steady income, regular checks. But Buffett's view turns that upside down. A dividend alone tells you almost nothing about the real risk or return of a business. There are a lot more important factors when picking out stocks than the dividend. For example, 99% of high dividend paying stocks lack high returns on invested capital, or ROIC for short. They lack high revenue or earnings growth. They also tend to have higher debt levels, as most mature business nibble their fingers in the debt cookie jar more than they should. ROIC stands for return on invested capital. It shows how much profit the business makes for every dollar invested in it. A higher ROIC means the company uses capital well. Revenue growth means the company is selling more or expanding its business. If sales stand still, the company may struggle later. Earnings growth shows profits rising, essential if you want compounding to work. Debt levels matter because heavy debt increases risk. More interest, more financial strain, less flexibility. Dividend yield is simply the annual dividend per share divided by the share price, how much income you get today. Dividend payout ratio is the percentage of earnings the company pays out as dividends, how much of its profit is being given back instead of being reinvested. A high dividend yield looks attractive, but if the payout ratio is huge, debt is high, growth is weak, or ROIC is low, then the business may actually be riskier or offer lower long-term returns. A big misnomer is that dividend stocks are safer. A key question arises here: what does safe mean? Yes, they have lower volatility, which means that when the market drops, they tend to drop less on a percent basis. But volatility is the best friend of a long-term investor. When the market drops, we should be smiling, as this means cheaper prices for higher quality stuff. The real safety is to have a business which does not have a high debt risk and a business which consistently grows and allocates capital in the most efficient manner. Dividend stocks lack this, and I will prove it in just a short few seconds. Buffett has said that companies paying large dividends may be signaling they don't have better reinvestment opportunities. That means the lion's share of future return must come from the dividend itself rather than growth, and growth is the engine of compounding. Let's look at how Buffett applies this. Berkshire Hathaway owns many companies that do pay dividends, such as Coca-Cola, Apple, and others. But Berkshire itself does not pay a dividend. Why? Because Buffett believes the retained profits and reinvested earnings generate higher value for shareholders over time than if the cash were distributed. When he invested in Coke or Apple, the dividend was a bonus, not the main reason for the investment. He invested in these companies because of their moats, low prices, their long runway for growth, and very high ROIC at the time. He would have invested in them even if they didn't have a dividend. Most probably he wished they reinvested these dividends instead. What's Buffett's own reflection? By not paying a dividend, Berkshire, his company, has been able to retain earnings and compound them over decades, generating extraordinary growth. This is why he called his one-time dividend payment in 1967 a bad dream, as this 10 cents per share dividend distribution would now be worth close to $4,000, which is a return of 40,000 times. If you chase high dividend yields, you may be entering a trap. Research shows that among dividend-paying stocks and dividend-focused funds, the very highest yielders often lag the broader market. For example, according to Hartford Funds, over decades, the top 20% of highest dividend-yielding stocks underperform the S&P 500 more often than not. A document from WisdomTree shows that a high dividend index yielded more income but had lower overall returns compared with the S&P 500. In practical terms, if a company commits most of its profit to pay dividends, which means to have a high payout ratio, and grows slowly or has large debt, then its total return may be lower than a company that reinvests and grows. Here's why. The payout ratio matters. If a company pays out 90% of its earnings every year, it has little left to reinvest in growth. Growth slows, ROIC falls, debt may rise. Eventually, the dividend becomes unsustainable or the share price stagnates. Meanwhile, a company that retains 30% of earnings, reinvests wisely, grows sales and earnings by say 8 to 10% annually, and keeps debt manageable, over time that compounding often beats the income check. Also, we must not forget that paying out dividends is tax inefficient. This matters. Dividends get taxed in many jurisdictions immediately, while retained earnings grow within the company tax deferred. Buffett has pointed this out. If a company wants to give money back to its shareholders, it should wait for the stock to be undervalued and buy back shares. This is a much more prudent way of cash distributions, but I will explain this in a separate video, so please subscribe for more. High-yield companies frequently have another hidden risk: elevated debt. The payout may look attractive now, but debt servicing pressures or economic stress can force a cut. A high yield may therefore be a signal of risk, not safety. Research from Starlight Capital explains high-yield stocks typically pay out a high portion of their free cash flow or net income towards dividends, leading to a high payout ratio. These stocks may also have funded their dividends with debt issuance, leading to higher leverage ratios and risk. Growth matters too. If earnings and revenue don't increase, then the static dividend must do the heavy lifting. If the business is shrinking or stagnant, the share price may fall, wiping out the dividend yield and more. So when you see a company paying a generous dividend, ask, what is the payout ratio? Is the company paying out 70 to 90% of profits? How fast are revenues and earnings growing? What is the company's ROIC? What is the debt level relative to equity and cash flows? If growth is weak, ROIC is mediocre, and debt is high, then the dividend may not compensate for the risk or lack of appreciation. I have put a free investment checklist in the description with which you screen a dividend stock in under a minute. Grab a copy for free in the description. What about dividend-focused funds versus broad market funds? The data showcases it all. A comparison on Seeking Alpha shows that the S&P 500 had better overall performance than many dividend-oriented funds or strategies over multi-year periods. Take the Wisdom Tree data. Over the period April 2014 to June 2023, the High Dividend Index had an annualized return of approximately 7.8%, while the S&P 500 had approximately 11.9%. The high-yield strategy lagged by over 400 basis points per year. In 2024 and 2025, the results prove this even more. Although broad dividend income is important, in recent decades, the major driver of stock returns has been capital appreciation, not just the dividend check. For example, from 1957 to May 2025, dividends accounted for about 24% of the S&P 500's return. The rest was price appreciation as stated by Invesco. In short, income alone is not the same as total return, and high yield may come at the cost of growth, risk, or both. If you are truly in love with receiving some dividend payments, the dividend payout ratio is a better metric than yield to look for. The dividend yield tells you how much income you'd receive today, but the payout ratio tells you what portion of the company's profit is being given back. If a company pays 6% yield but that represents 90% of its earnings, it means there's little left to reinvest in growth or shore up the business. If earnings drop, the dividend becomes vulnerable. It may be cut, slashed completely, or the dividend growth may stall. By contrast, a company with a 2% yield and a 30% payout ratio may have ample internal reinvestment capacity, growth prospects, and lower risk of a cut. For long-term returns, payout ratio is often a better signal than yield alone. Buffett's logic boils down to this. If a company or his own company can earn a higher rate of return by reinvesting profits than shareholders could earn by receiving dividends and investing them elsewhere, then retention of earnings is the smarter move. When the company doesn't have better uses for cash, then a dividend might be appropriate, but that's rarely the case with his style of business. Or it is rarely the case if you want to have higher than average stock market returns. In his shareholder letters, he has repeatedly emphasized that the first priority of capital should be reinvestment in the business, growth, acquisitions, or stock repurchases when the company is undervalued. When a dividend replaces those opportunities, it implies the business has no higher return projects. By rejecting dividends at Berkshire, Buffett has allowed the compounding engine to run uninterrupted. That doesn't mean dividends are always wrong. It means they're not the default choice when growth opportunities exist, and they are not the default choice for value investors which want to beat the market consistently. If you are investing for the long term, here are some takeaways from Buffett's view. A high dividend yield alone does not make a business low risk. The debt level and a strong moat make it less risky. Always check growth in revenue and earnings. If these stagnate, the dividend may look good now, but total return may suffer. Check ROIC. A high ROIC means the business can reinvest profitably. A consistent level above 12% is a must. The higher, the better. Check debt levels. High leverage increases risk, especially during economic stress. Check debt levels in relation to the equity of the company, in relation to earnings, and in relation to cash flows. Look for debt to equity level of below 0.8 or even better, debt to equity level of below 0.5. Check also for debt to EBITDA levels of below 2 or below 1.5. Also check debt to FCF levels. A level of below 2 is a really strong sign. If all of this is new to you, or if you appreciate this explanatory content style, subscribe. I promise I won't disappoint. Check also the payout ratio. A very high ratio may squeeze reinvestment, leave little cushion, or signal slower future growth of both dividend returns and overall stock returns. Payout of below 60% are considered strong. Below 40% is best, but it also depends on the industry. In future videos, I'll talk more about this. Consider the tax and compounding implications. Retained profits within a good business may produce more value than immediate income. In the end, most investors should want a higher overall return rather than just a monthly or quarterly dividend. Buffett didn't reject all dividends. He invested in companies that paid them. But he never invested in a company solely because it paid a dividend. He liked the other key fundamentals of the business, and the dividend was just a cherry on top, not the main dish. All the while, for his own enterprise, he saw greater long-term value in retention and reinvestment. Buffett's stance on dividends might seem counterintuitive to many income-hungry investors, but once you recognize his focus, durability of the business, reinvestment opportunities, compounding of retained earnings, the picture becomes clear. A dividend is not a guarantee of safety. It's a return of capital. And unless that capital could not earn more inside the business, paying it out may reduce the engine of long-term growth. For Buffett, the biggest mistake would be paying dividends when the business still has better use for money. His 10 cents per share mistake costed him a 40,000 HR return. And maybe the most important lesson is this. When an investor sees a business paying a dividend, the wrong question is, how much income will I get now? The right question is that really the correct way I want this cash to be distributed? Because in the world of compounding, giving away cash today might mean giving away tomorrow's growth. Grab your free investment dividend checklist down in the description, and I'll see you in the next video.